Hello, everyone. Welcome to Wall Street from Main Street podcast. My name is Mo Dawood, and today's special guest is Michael Underhill. He is the Chief Investment Officer at Capital Innovation, and he's also the author of the Handbook of Infrastructure Investing. Michael, thank you for joining us.
No, it's a pleasure to be here, Mo.
Well, I want to start off this podcast by talking about your background for people out there that haven't heard about you before. So, do you mind telling us about your background and where you your career and where you've been before you became the Chief Investment Officer at Capital Innovation?
Certainly. I've spent the last 24 years in the investment management business. I started out in the late 80s at Lehman Brothers, and as a bond analyst, I looked at anything that included municipal bonds, corporate bonds, really focusing on credits, but also project finance. So municipal bonds is really where I got my start. Moving from Lehman Brothers on to a fixed income shop, Federated Investors, based in my hometown of Pittsburgh. Work there, providing fixed income investment management solutions to bank trust departments throughout the United States. So both taxable and tax exempt. And I think, living through the early 90s, particularly the rate increase, and when you look at 1994 to 95, February 94 to February 95, the Fed raising rates, it really brings back some not so pleasant memories. And really, when we'll talk a little bit about that later, but when you look at what we have today in the currency markets with a potential rising interest rate environment, there's some invaluable lessons over the last 2.5 decades that I can sort of tear a page out of history. But notwithstanding some of the time I spent there at Federated, both in the fixed income area, but also then gaining some equity experience, I went on to work at Janus Mutual Funds in Denver, Colorado. From there on to Invesco in Denver as well as in the West Coast, but handling institutional accounts, working with corporate treasurers, some state retirement plans, as well as some insurance companies, and providing asset management services across the spectrum of both equity, fixed income products on a global level, things like infrastructure, agriculture, natural resource investment strategies. And then my last stop in 2001, I joined AllianceBernstein, and while there, provided again asset management services to large institutional investors working with equity-based real assets. And after working for admittedly about 16 years at all of these large asset management firms, I decided I wanted to strike out on my own. And so in July of 2007, I started Capital Innovations, brought together a team of investment professionals. And all we do is specialize in delivering customized real asset solutions, separate accounts for large institutional investors, as well as we manage a series of retail mutual funds and unit investment trust structured products for the brokerage community and for some high net worth investors.
That's interesting. So you used to work at Lehman Brothers, and you left Lehman Brothers. Is there any reason? Is it because of what's going on at Lehman Brothers? Because they were doing a lot of speculating in the mortgage-backed security and also in other areas as well. Would that have anything to do with why you left?
Well, actually, when I was at Lehman Brothers was 89 through 91. So,
okay,
I was there at an early point in their time. Actually, it was the heyday of the municipal bond market at Lehman Brothers at the time, and so their structured products group and derivative products group that later led to some issues during the financial crisis. I was not at Lehman Brothers. I did have one or two friends that were still working there, and so I looked at Lehman Brothers with such fond memories of the late 80s, early 90s, and what the place was. I look at the eventual downfall of the organization as a result of some structured products and some asymmetric risks and bets and things like that. And I think it's really unfortunate on so many levels to the retail investor. When you look at some of the things that happened there, it's never good to see an old employer suffer like that. It's never good to see the employees as well as their clients suffer like that.
I agree, and I think like the culture at Wall Street has evolved in the past decade or two. I mean, Wall Street used to invest for the long term, invest in good companies, and try to, break a profit that way. I think it look like now they're more short-term thinking, trying to make a trade and try to make a quick profit. Now, do you agree with that?
Well, I think that's one of the main reasons I went out and started Capital Innovations. We're an employee-owned asset management firm. All we do is long-term investment management, investing in real assets as an asset class. We're an employee-owned asset management firm, and so we don't have any outside owners, outside influences. We are not a publicly traded company, so we're not forced to do things on a short-term time horizon. And so we are truly long-term investors and not short-term speculators. And so the way I look at this is investing is a marathon, it's not a sprint. And running 26 marathons in the last 20-plus years, I can personally attest to the fact that you get to the 24th, 25th mile of the marathon, it's much more difficult than the first or second mile of the marathon, and not unlike investing. If you've been in the investment management world for 25 years and seen some of the things we've seen, investing has become more difficult. It hasn't become easier. Go ahead.
Why do you think Wall Street culture has evolved into becoming short-term thinking, where they have high-frequency trading, or where they make a quick buck making short-term trading, rather than a couple of decades ago they were more long-term? What happened between then and now?
Well, I mean, no, that's a great question. I think if you can drill down on one word, it's governance. You don't have the right governance models on Wall Street like you did before, and all governance means, it's like the word integrity, is making sure that people do the right things when nobody's looking. And having the right governance model, making sure that the investment management professionals, the investment bankers, the investment professionals, the financial analysts, all have a governance model and alignment of interest to do one thing, and that's to make the best decisions for their clients. And I think where we've lost our way is that there are various forms of governance models where asset management firms, investment banking firms, they get paid a fee regardless of whether it's a good deal or a bad deal. They get paid a fee regardless of whether they make their clients money or they lose money. And, we look at the world we live in today, and going out and starting a firm in July of 2007 at exactly the wrong time. We lived through the financial crisis. I kept 93% of my net worth in our investment strategies. And I tell our clients that I don't invest on their behalf like it's my money. I invest on their behalf as if it's my money today, and because I've invested in this manner, they can invest alongside me. And so having a concentrated portfolio where your portfolio manager and your investment professionals have significant skin in the game. And so that way they feel pain, the portfolio manager, investment manager, fund manager feels pain whenever the client feels pain. And whether that's 2014 in the energy markets or 2015 in the currency markets, if the clients are feeling pain, I want to make sure I'm feeling pain, because if I'm feeling pain, it's uncomfortable, and I'm going to do something to rectify the situation in the portfolio. I'm not just trading to generate trades. I'm trading and generating long-term investment results for my clients.
Well, let's shift gears here and talk about the economy. Now, there's a lot of uncertainty in the market right now as investors wait for the Federal Reserve to make their next move. I read an article today that one of the Fed governors was talking about increasing the rate in the middle of this year. I personally think that's not going to happen. I think they're just talking a big game because for the past, ever since the financial crisis, they've not done what they said they would do. So I want to get your thoughts on that.
Well, I think that's another great question, because when you look at where we are today in the cycle, I don't think you can really increase rates today in the U.S. without causing some massive dislocation and massive contagion in the marketplace. And I say that because you look at what's gone on, even just in the last 24 hours. Look at what the Swiss bank does. Swiss National Bank basically took the cap or took the peg off their currency, and they were pegged to the euro. And look at what kind of volatility that's created on a global level. And when I look at the correction in the energy markets and low price of oil, right now the U.S. is in more of a deflationary environment because of what happened with oil. And so I think that's really kicked the can down the road, so the Fed, it really doesn't have to raise rates. in the first or second quarter 2015. I think if they just continue down this glide path, let the economy continue to generate some momentum, and I think when you look at productivity and where we are, there's no need to raise rates today, this week, this month, this quarter, or even this year. But that being said, I think the Fed is doing a lot of posturing around when it should appropriately raise rates. And I really don't think in 2015 you're going to see the Fed raise rates, because if they do, that'd be analogous to driving down the freeway at 60 miles an hour and stepping on the brakes. I think they'd cause some massive dislocation in the economy and cause some massive volatility.
And that's a great point. And just think about it. If they raise rates, even by a little bit, it can cause massive impact on the economy and even across the board, even in government as well, because an increased rate will put more pressure on the federal deficit and on the budget. And I don't think they want to do that to the U.S. government as of now. I think the theme right now is trying to kick the can as far down the road as possible. And when they have another crisis, they'll shift the blame to someone else. Probably make up somebody to put the blame on. Except, I mean, they should take a lot of responsibility of what's going on in the economy, the Federal Reserve and the government.
Well, and I think you have some great points, though. You look at tumbling oil prices, and they've strengthened rather than weakened the Federal Reserve's resolve to start raising interest rates around the mid-year, even as volatile markets and the softening U.S. inflation outlook has made investors, push back the timing of what's going on. But, even these Fed officials, they were interviewed earlier, fourth quarter, in the last month, and they suggested that they remain confident the U.S. economy will be ready for a modest policy tightening in the June to September time period. That being said, they saw a massive correction in the energy markets late fourth quarter, and even into the first 2 weeks of the year, we've seen a massive correction in the energy markets. So, we're now on a deflationary glide path, and so falling oil prices they're positive for the U.S. economy, but you're not going to see it come through for at least 2 to 3 financial quarters. So, the Fed has a 2% inflation goal. Right now, we only have 1.3% inflation, so I don't think we've reached the inflation goal that they need, and so they really don't have there's no real impetus to raise rates.
Yeah, and there's a lot of positive and negatives about the low oil prices. I mean, one of the obvious positives is that we get lower gas prices for U.S. consumers and other things as well, but the negative is that a lot of the shale oil jobs in this country will probably go away. So that'll put up a lot of pressure on the unemployment numbers. Because a lot of the shale oil companies cannot make a profit at today's oil prices. They need oil prices at least $70 for most of them.
Well, I think I think you're absolutely right. I think we need a rebound in oil. And across 26 different Bloomberg forecasts, I see no one has a forecast for sub-$60 a barrel oil. So it's going to come back before the end of the year. So before the close of 2015, we'll see oil around $60 a barrel. But what I'm also saying is I see what you're seeing, and I don't disagree with you. And when you look at unemployment, the last time we had meaningful uptick in unemployment was because of the housing debacle, the financial crisis. And you saw a lot of jobs go away because the housing market rolled over. Those people in those manual labor jobs, they migrated into the energy sector. And those were nice, high-paying jobs making $90,000, $100,000, $150,000 a year, working on pipeline operating companies, working for some of these exploration and production companies. With a correction in oil and WTI bouncing from 45 to 50, it's tough to keep those people employed. And so you've already started to see the first round of layoffs in the last 3 weeks. You're seeing layoffs in the energy and oil patch, and whether it's in North Dakota or the Haynesville or the Bakken region. But I see some of the things, you could pick up the newspaper and look in Ohio. 600 people lost their jobs at a pipeline fitting company in which all they did was make parts for some of these exploration and production companies in the oil space. So some of the machinists and the other industries that are tied to the oil industry, there's not a catalyst for additional exploration and production. So these ancillary businesses, oil field services businesses that feed in, you're going to see some unemployment in the next 12 months.
So what do you think the reason behind the drop in oil prices? There's a lot of theories out there. A lot of people thinking that Saudi Arabia was behind the drop in oil prices because they wanted to punish the shale oil the U.S. shale oil companies, and also they want to punish Russia as well. But there's also a lot of theories out there. What is your uh, um, conclusion or analysis on why you think the oil prices dropped?
Well, it clearly was a supply side issue. I think when you look at demand side, there have been talks around weak demand for oil, but clearly as the Saudis controlling the supply side, continuing to produce oil, that and as well as, the US producers, US shale producers, the US has continued its march towards energy independence. So it's not just the Saudis, it's the Saudis not budging on production, but it's also the US not budging on production. And so you see these two major players continuing to produce oil, and it's just a simple supply-demand situation where you have excess supply, and to try and take down all of that supply from a demand side pull scenario, we're in a high volatility, slow GDP growth environment. The U.S. economy is doing well, slow GDP growth, but it's almost the least sick patient in a hospital full of very sick patients. The European economy is not doing well. It's doing okay. I don't see a lot of other economies that are hitting on all cylinders, quite frankly. So the U.S. economy is doing well, but it's sustained by its own energy exploration and production. So I think the Saudis have really made some comments, very, very strong comments to elicit a reaction. The fact that they're not going to adjust production, the fact that they said, we don't care if oil is sub $40 a barrel. And then all of a sudden you see the commodity speculators come out of the woodwork and oil corrects. WTI drops $5-7 dollars. So, I look at the situation we're in today. It's clearly supply-driven, an excess supply by the Saudis, plus it's gamesmanship. They've been talking about how they don't care what price it is, and they really are focused on keeping up their production and market share. Yeah, I think it's an aim or a goal to elicit a reaction and drive some of the weaker hands in the shale oil producers in the U.S. out of business, as well as you look at oil as a weapon. Rather than the Saudis have to launch missile strikes, or rather than the Saudis having to actually wage war with any kinds of troops, they can use oil as a weapon, and they've done it successfully with other countries in the Middle East, and whether that be Iran, or whether it be subtly or not so subtly sending a message to countries like Russia for some of their aggressive actions in the Ukrainian region.
And that's an interesting theory. We'll see what happens with the oil market down the road, but I agree with you. I think oil prices should be around $60 by the end of the year. If there's a free market in oil prices, it would come back up today, because a lot of the producers right now can't even make money at today's prices. So let's shift gear here and talk about the agriculture sector. And I want to, as an investor, has your investment strategy in the agriculture sector changed as more consumers are shifting toward eating more organic food?
Oh, absolutely. I mean, we have a couple themes in our agriculture funds that we run, as well as our institutional accounts. But I look at some of the big themes. One of the big themes is organic food investment and consumption trends. You're seeing not only organic consumption in the U.S., other developed markets in Europe, but also emerging markets like China, Brazil, even places like India. So I look at some of the organic food trends, and right now there's a forecast that about $200 billion worth of capital investment will occur in the organic food space in the next decade. $200 billion. So that's a significant amount of investment. And I think you're seeing it across the spectrum. Companies like Boulder Brands, which produces gluten-free bread, or White Wave Foods, which actually White Wave produces almond milk, soy milk, and organic milk. And you're seeing it not just from individual consumers, but also institutional adoption, where large school districts are actually adopting organic milk, soy milk, and almond milk for a large number of the students that have food allergies. So you're seeing an expansion of organic foods across a continuum of different consumer demographics, as well as across a broad spectrum of geographic regions. So, organic foods plays a big investment. It's a theme in our investment thesis for our agriculture strategy. One of the other things that we're seeing, we touched upon energy. When you look at low energy prices and you look at the fact that oil has had some price correction, but natural gas, think about upstream agriculture investment, fertilizers. A lot of people have been trying to play investment in companies like potash. There's an oversupply of potash, not a lot of demand for it right now, or demand is constant while supply is continuing to increase. Conversely, I look at nitrogen-based fertilizers, so companies like CF Industries or Mosaic, which have nitrogen-based fertilizer capabilities. When gas goes down in price, companies like CF Industries that make nitrogen fertilizer and their input cost is gas, if your input cost goes down 30%, you have more free cash flow generation, and that's why you see companies like CF Industries, it's up 7-8% in just in 2015. And we continue to maintain our bullish position on nitrogen-based fertilizers.
And I agree with you. Organic food, for consumers that are eating more organic food, it's becoming more and more of a trend. It's becoming more mainstream as well, as a lot of restaurants are shifting toward organic food. I know companies like Chick-fil-A are looking into getting antibiotic-free chicken, and then also a lot of people are shifting away from eating stuff like McDonald's or Burger King, other fast food joint, and shifting toward a restaurant like Chipotle or other restaurants that use better food qualities. So for investors out there that want to get exposure to the agriculture sector without playing in the futures market, we get this question a lot. How can people do that?
So if you want to play the agriculture space, you have to decide if you want to invest in publicly traded securities or if you want to invest in a private fund or even buy land. I think some of the best ways to dip your toe in the water, I mean, there are funds out there that have agriculture exposure. There's a mutual fund, ticker symbol INNAX. It actually has diversified exposure across agriculture, timber, and infrastructure, but you look at the agriculture exposure, it actually has a broad spectrum of upstream, midstream, and downstream agriculture. And so you can get into a bit of exposure in the agriculture space through things like mutual funds with as little as $500 of investment.
Now, I want to shift gears here and talk about our last topic for this podcast, which is infrastructure investing. That's also your expertise. You also wrote a book on that. So for investors out there, I think infrastructure investing is now a popular subject out there among investors on the retail side. I mean, you talk to people out in the street, they're talking about investing in Netflix or Apple or Amazon, maybe oil market, but infrastructure is not on top of their list. So why should investors put their money in the infrastructure sector, and how can they invest in that sector as well?
Well, again, I look at what's going on in the world today, and you brought up a great question that infrastructure as an asset class has long-dated assets with consistent cash flow. And really what you're trying to do is get into an asset class that has an ability to provide you with capital appreciation and yield. And when you look at infrastructure, simply put, as an asset class, it really has a unique characteristic because you're actually getting long-dated assets that give you cash flow. They're giving you, and that cash flow is tied to long-term contractual feed-in tariffs. You're able to invest in an asset that, admittedly, when you look at global trends, they're impacting infrastructure investments. And when you look at infrastructure, it's all around us. You're basically looking at permanent assets that are involved in societal, call it essential services and societal development. In other words, if you look at it, operations, transportation, energy, communications, and water. And when you look at different types of infrastructure, the infrastructure investment you can make are in businesses. Pure play infrastructure investing best replicates the unique investment characteristics of infrastructure as an asset class. In other words, if you're focused on infrastructure, invest in the pure play spaces. So companies with high barriers to entry and relatively inelastic demand. So as a result, transmission and generation of power, oil and gas storage and transportation, toll roads, seaports, airports, communications, so think towers and satellites, as well as water, bridges, and tunnels.
And I don't know if people realize this, but for an infrastructure investing is going to be very important going forward because a lot of the bridges, water pipe, and railroad, they haven't been touched for nearly a century. So, and a lot of them are wear and tearing and they're in bad shape. And I was reading your white paper and I was looking at the grade by the American Society of Civil Engineer, the report card they have for America's infrastructure, and most of the grades we got for this country were D and C's, and only B we got was in solid waste. So it tells you that infrastructure investing is going to be very important going forward because, like the electricity grid, it's very outdated and need to be updated. And what I'm hearing is the electricity grid is basically being held by paperclip and bubblegum, so to speak. So I think infrastructure investing is going to be very important for this country.
Yeah, and I think you hit the nail right on the head. When you look at the positive fundamental backdrop, the long-term structural drivers for global infrastructure, and when you look at the asset class, investment in roads, rail, telecommunications equipment, electricity, and water will total over $53 trillion from 2010 to 2030. And this is according to the Organization for Economic Cooperation and Development, what's commonly known as the OECD. And so I look at various geographic regions. I look at North and South America. I see new sources of production support, continued strong secular demand for energy infrastructure assets. I look in Europe, and I look at the economic recovery, and they've made a lot of their strides in economic recovery because of infrastructure spending, and the improvements basically are a top priority for the governments. And I even look at the emerging markets, places like emerging Asia Pacific. Right now there's a real demand for infrastructure upgrades and expansion. It's being driven by accelerating urbanization, growing personal incomes, economy. You look at their economic growth and the increasing foreign and private investment. I think there are numerous advantages of investing in infrastructure on a global level, whether it be the energy renaissance in the Americas, the economic recovery in Europe, or addressing the growing needs of Asia.
And that's a good point. And as you said, investing in infrastructure also provides a good yield for people that are hungry for yield, because I know the Treasury bond market is not providing great yield. And if you factor in the inflation, you're basically almost getting no return. So investing in infrastructure would be a great alternative for investors out there that want to get yield. So, Michael, thank you for your time. And if people want to find out more about your company and if they want to buy your book as well, where can they go?
So if you visit our company website, we can be found at www.capinnovations.com, and I'll spell that out. That's CAPINNOVATIONS.com. If you want copies of our book, they're available on Amazon, or you can just give us a call and we can send one out to you. Our corporate offices, our telephone number here, 262-746-3100.
Okay, great. Well, Michael, thank you for joining us, and hopefully you can come back on again soon.
My pleasure, Mo. Have yourself a wonderful weekend with your family.